Now let's talk about butterflies. So butterflies are important to understand for us to be able to move forward as well. And then once we finish this, we'll be done with our option primer. Okay, so what do we do with a butterfly? A butterfly looks like this. I'm going to buy the 304 call, just like we did before. And let's say, again, it's $3. I'm also going to buy, let's just say, the 308 call in case price goes even higher. Now, let's say that one costs us, let's say it costs us $2. And so we got $5 of cost here, but we're going to sell a middle strike. We're going to sell two of them. So this is 1 plus 1 plus 1. There's just one call here, one call here. We're going to sell two of the middle strike. You notice how they're equidistant, right? 304, 306, 308. And let's just say these are 220. And two of them. So you get $440 of credit against $500 here. So the whole trade cost us 60 cents. Just as an example. Okay? Now we have to take a look at what happens. So, or what it is that we're looking to have happen. Well, what you'd love to have happen is you'd love to be able to see price park itself right there, work its way from 300, like we started off with, and work its way. You think maybe the move is to 306. Maybe there's some resistance there. Maybe there's a moving average there. Maybe that's just a previous target. We'd love to see it go to 306. And the reason why we want it to go to 306, I can show you by showing you what happens to these strikes. So the first thing that happens, I'm just going to redraw it over here, 308, 306, and 304. If price stuck right here in the middle, right at 306, well, the 308 call is out of the money. So this isn't worth anything because price isn't anywhere near it. The contract is not worth 308, is it? Because price is at 306 at expiration. So this particular strike is worthless. Okay? The 306, and there's two of them here. If price is at 306, how much are the 306 calls worth? 306, 306, no value. They both expire worthless. The 304 call, however, is worth $2, isn't it? Because price is at 306, you have a 304 call, the difference is $2, so you made $2. Minus the 60 cents that the whole trade cost you, you made $140. So that's kind of how a butterfly works. Now, the interesting thing to understand about it is what happens if price finishes above the butterfly or below. This is what happens if it finishes somewhere in the middle. And what you can obviously tell from this is if price finishes, let's just say not at 306, but it finishes at 305, like right in here, you can see that this call is worth $1. So you made $1 minus the 60 cent cost. When it finishes here, it's worth $2, right? When it finishes here at 307, if you did the math, again, it's only worth $1. And that's something that we can talk about. We'll talk about that in other videos in terms of calculating the math. But what I want to show you is what happens if it finishes above and below. So I'm going to switch colors here for a second and just do some fast math so we can move on. Remember, there's one of these, there's two of these, there's one of these. What happens if price finishes at 309? Easy math. You've got a 304 call. If you look at the price, this is the current price. I'm going to circle price, okay? If that's the price and you have a 304 call, it's worth $5, right? Or 500. You have a 308 call and price is at 309, that's worth $100. So you've got $6 that if you were to sell this butterfly as one component, you bring in $600 from these two strikes, but you are short 2 of the 306. So 306, the difference between 306 and 309 is -3 because you are short those. You owe $3. Okay, remember I said you never want to do this naked by itself? Well, that's why you do it inside of a vertical or a butterfly, because you're protected. And look what happens. You've got 2 of these, the difference between 306 and 309. You got 2 of them. That's -$6, right? Plus 6, -6, that's called a wash. So if price finishes outside of your butterfly to the upside, nothing happens. Whatever you paid for this, let's say you paid 60 cents or $60 for the butterfly, you lose the $60 because it's a complete wash when the market, when your broker calculates how much you made, how much you lost, it ends up being 0. So you didn't make anything, you didn't lose anything, but you spent $60 for the opportunity, so you lost the debit that you paid for it. Now, what happens if it finishes down here? Well, this one's super easy. So let's say it finished at 302 or whatever, right? Some number below. Well, the easy answer is, right, the 304 expires worthless, the 306s expire worthless, and the 308s expire. They all expire worthless because price is below it. This is called it finished out of the money. All of these are out of the money. $0. You didn't make any, you didn't lose any. The whole damn thing, all 4 contracts expire worthless. So what happens? Again, you risked 60, you lost $60. So it's important to understand that when you have a butterfly, boom, 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 you make money if it lands somewhere inside the net of the butterfly. That's why we call it a butterfly, because it looks like this. But if you finish above it, 0. If you finish below it, 0. Well, what does 0 mean? It means you lose the debit that you paid for it. This means you lose the debit that you paid for it. So you only make money if it finishes somewhere in the net. And that's what a butterfly is. Okay? So that is the options primer. So you have a little understanding of what a call is, what a call vertical is, how that's better than a call because it's less expensive and has a lower break-even point. And you can be right with a call, but still not make any money if the move isn't great enough. But with a vertical, it doesn't have to be as big a move, and it's less risk on top of it. And now you know what a butterfly is. So now I'm going to show you this interesting little thing that you may have, some of you that are brand new to this may have already figured this out. But I'm going to show it to you anyway, so that this will set you up for Convert the Vert. So when we bought this butterfly, I'm going to break this thing apart. 304 call, 306 call, 306 call, 308 call. So if you really look at it, at the pluses and the minuses, we bought a 304 call, yes? We sold 2 of the 306s. So let's just say this is one of them. This is called a call debit spread. It's a vertical, but we refer to it as a call because they're calls. We refer to it as a debit spread. Keyword, debit. That means it costs you something. Credit spread is when you get paid for it. So is everybody clear that you bought 1, sold 1? That is like our first example of a vertical, right? This is a call vertical, otherwise known as a debit spread. Over here, we sold the 306 call, and right, because we have 1, 2, right? That makes the 2 of them. This is just 1. And then up here, this lonely one up here, we bought 1 of those. So if you look at this, I'm going to just draw it this way. This is called also a call vertical, but this is called a call credit spread. Keyword credit. It means you got paid. So when you look at a butterfly, what is a butterfly really? It really is two verticals combined: a debit spread that costs you something and a credit spread where you get paid a credit for. And when you put them together, they are actually called a butterfly because you got +1 here, you got -1 here, you got -1 here, same strike, and +1 here. When you add these two together, you have -2, then you have +1, +1. And isn't that, in fact, a butterfly? So a butterfly is a debit spread, and on top of it is a credit spread sharing the same short strike, the same minus strike. Okay? Pretty cool. So now I can move on to convert the vert, because if you don't know what a debit spread is, if you don't know what a credit spread is, if you don't know how they combine to become a butterfly, it can be a little confusing. So now I'm going to tell you a little bit about SPY, SPX. Then I'm going to go over the genesis of CTV really quick and get right into the strategy. And like I said, I'm going to show you every aspect of the strategy that you can do without any special indicators. You will be able to walk away from this and be able, watch it maybe a couple of times, take some notes the second time around, and you'll be able to open up your computer, take a few notes, do a few practice runs, and be able to do convert the vert. I promise you. That is what I'm looking to deliver. Okay, so let's talk about SPY for a moment. So SPY is otherwise known as the S&P 500, but it's called an ETF. So this is all 500 stocks of the S&P 500. And they're weighted for bigger stocks, bigger cap stocks, capitalization, obviously way more than smaller capitalization stocks. It's kind of a unevenly weighted ETF. And you can actually buy shares of it. You can buy shares of the SPY. You can buy options on the SPY as well, just like we did before when we showed you can buy shares for 300, or you could buy for $3. You could buy a contract that controls 100 shares. That's a call option. Not that these prices are the same, but you can buy shares and you can buy options on the SPY. There is also something called SPX. Now, SPX is the cash index of the S&P 500. What does that mean? Well, there is no stock, okay? There are no shares. It's literally just a cash index. So because there are no shares, you can only trade options on it. You can't buy stock or buy shares or trade shares. You can only do options. And it is incredibly liquid. And we show you in the actual CTV product how to scale properly so that you don't blow up your account and you don't do too much. Start off with one. It's fantastic. So SPX is so good as a cash index for so many reasons. One of the reasons is that it cash settles. You could literally buy an SPX call tomorrow and hold it. And if it continued to go higher, if price on SPX continued to go higher and your expiration was, say, Friday, you don't have to close it. There's no commission. You don't even have to be there. You could just walk away, assuming price was higher and higher and higher. Why? Because it just cash settles. If you bought the thing for $400 and the price went up, let's just say, I'll show you what the prices are. Let's just say it went up, $10 potentially. You made $1,000. Your account would settle. If you spent $400 and it went up, $10, $1,000, you would cash settle. You'd have $1,000 deposited into your account on Friday expiration. At the end of the day on Friday, boom, and then Monday morning, $1,000 is cleared in your account. It cash settled. You did not have to close it. You didn't have to be there. You didn't have to instruct anybody. It literally just cash settles wherever price lands. That's how much it cashes for. And if obviously, as all options are, as I said, if you took an option and it finished below your strike price, it would cash settle at what? 0. If it was $1 more, you'll have $1 in your account. If it was 1,000 more, you have 1,000 in your account. It just literally cash settles. So the two things that are awesome is that because there are no shares, you can never be assigned. So there's no threat or risk of being assigned the stock, having a margin call, or any of those kinds of things. That's cool. And number two, it has a cash settle feature where you can just let it expire to the end of the day and it'll just cash settle. That simple. Now, SPX runs exactly, if you looked at candlestick patterns, it looks exactly like SPY, except it's approximately 10x. So if the SPY is like, 540, then SPX is somewhere around 5,400. What does that mean? It doesn't mean anything, really. It's just a number. So when you were, instead of buying the 540 call, you'd be buying the 5,400 call. Now, these are going to be more expensive, which means verticals are an absolute necessity until you become really experienced with how to trade SPX. But I just wanted you to understand the relationship that if you were to look, in fact, I'll show you right now, the two charts side by side. Can you see it's the same? So you can see up, it peaks up here, gives you a little wick up here, peaks here, gives you a wick here, kind of a double over there. Then they turn red, bang, bang, gives a little lift up, and then down she goes, down she goes. Then it comes up a little over here, comes up a little over here, and then 3 candles, bang, 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 right? It's the same one. That's the SPY and that's the SPX. You can see this is like 5,990 and this is 598, 597, 598. So they look exactly the same. And just to give you kind of a little genesis of CTV, the SPX, this right here, this used to trade Mondays, Wednesdays, and Fridays only. So if you wanted to, you could put on a trade, say Monday or Tuesday, with a Wednesday expiration or even a Friday expiration. You could, on Monday, Wednesdays, and Fridays, you could buy a position on Friday and have it expire on Friday. Just cash settle, right? Which is pretty cool. You could literally buy something at, 1 o'clock in the afternoon on Friday. And if you were right, it would just cash settle. That's called 0 days till expiration, or 0 DTE. And they had them 3 days a week. It was pretty cool. And I had developed a strategy years ago. We didn't even have a name for it at the time. But what we used to do around 2 o'clock in the afternoon, I would look at a couple of things. I kind of worked this strategy out. I would look at the expected move for the day. Let's just say it's a Wednesday and it's 2 p.m. I would look at what the expected move was between now and the end of the day for this day's expiration. I would look at certain levels, previous levels, of the day. I would look at oversold, overbought indicator. Is it overbought? And is it going to go from overbought down to oversold? Is it going to go down from overbought to oversold this way? And I would come up with where I thought price would end up. And so we used to just buy SPX butterflies. And we paid about $1.50, somewhere in that range. And we did 10 wide butterflies. So if this is 59, this is 59.90. So we would do 59.90, 6,000, like 59.90 and 59.80, like 10 wide butterflies. And they cost about $1.50 because they were out of money, puts or calls, whatever it was, in the hopes that we would finish somewhere in the net at the end of the day. And they would just cash settle. So you could buy it for $150 and then let it rip, just let it go until the end of the day. And we were hitting them like crazy. I was really starting to nail them. But then something happened. SPX, they opened up the floodgates. And what they did was they made it available every single day of the week. So not only could you trade SPY for the day, Monday, Tuesday, Wednesday, Thursday, Friday, or SPX Monday. So what ended up happening is investors, the number of people trading on Thursdays and Wednesdays and Tuesdays, but buying just Tuesday's expiration on Tuesday. In other words, 0 days till expiration. In other words, they were doing what I was doing, similar, different strategies, but they would buy something in the middle of the day and look to close it out on the same day. 0 days till expiration. Not buying it like a swing trade on a Monday, hoping what happens on Friday. But you were never able to do it every single day of the week, only certain days. So now that they made it Monday through Friday, the volume of trading went up exponentially. And because it went up exponentially, the market started to swing in ways that it never did before. And I was wondering, like, I'd have everything lined up and ready to go. And so let's just say we were here, and I thought, okay, I know exactly where price is going to go. And this is probably not the greatest example, but I think price is going to pull back, and it looks like it's going to go higher. It's not completely overbought. It maybe does this, and it's going to land there at the end of the day. And then look what happened, like out of nowhere. What? Like, how did that happen? Or, I'd be trading something, to the downside and to the upside and the downside, and it started to hook, and I would see this hook. The expected move was like 11 points, and I had like an hour and 15 minutes left in the day with an 11-point move. I would take the number. It's 59.85, and I think, okay, 59.95, 96, maybe a couple more points. Let's do a butterfly right at 6,000. Bang, bang, bang. And it would start to go and then drop like this. And like out of nowhere. And so all of a sudden, the market is now swinging wildly at different times of the day on SPX and on the SPY. And you guys have watched it. You've seen it over the last year. As soon as they added 0 dates till expiration, Monday, Tuesday, Wednesday, Thursday, Friday, you see a lot more swings in the market. And a lot of that has to do with volatility and other the VIX and other factors, but a lot of it has to do with the sheer volume of calls and puts on 0 days till expiration. So let me explain something to you that took me a while to learn and figure out. And it's called what the market maker does. And oh, by the way, these $150 butterflies, I was getting more than one. You buy 5 of them, $750, you look like you're going to nail it, and all of a sudden it drops right through it. Or you put one on over, if it's here, and you put one on bang, 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 and you think, okay, it's going to chop and stay right in here, and then it does this, and then it does that, whatever, right? I'm losing $750 a pop. So I needed to find out a cheaper way of doing it and figure out this end of day swing. Okay. I'm really laying into the genesis of this because the more you can understand what the market was, what it became, what it has become, and what the market actually is doing and why, and then you learn the strategy, it all comes together, and it makes it so much easier to trade when you have all of this background. And I'm going to get to the strategy. I'm getting closer, trust me.
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comments section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.